In the echo of financial unease, Ray Dalio, a seasoned economic observer, has sounded the alarm, signaling a looming and potentially horrific financial crisis for America. The national debt has breached an alarming $34 trillion, setting off emergency signals in the economic landscape. Yet, the challenges don't end there. Geopolitical storms are brewing, with the Russian invasion of Ukraine, the intense semiconductor war between China and the US, and the unsettling conflicts in the Middle East painting a grim picture. As the nation stands at the brink of pivotal elections, internal issues further compound the complexity of these turbulent times. Join us as we dive into the critical factors that contribute to the ominous specter of a financial crisis in the United States. According to Ray Dalio, the United States is currently facing a potential debt crisis or is possibly heading towards one. In his analysis, he suggests that the nation may be at the beginning of a classic, late-cycle, large-scale debt crisis. This situation arises when there's an imbalance between the production of excessive debt and a shortage of buyers in the market. Dalio highlights the critical issue of selling this surplus debt and emphasizes the necessity of having enough buyers for it. Notably, he points out changes in the global landscape where large investors who incur losses in various financial instruments, including treasury bonds, may alter their investment strategies. Additionally, geopolitical shifts such as concerns about sanctions and global power competition further complicate the scenario. Examining the supply-demand dynamics of government debt, Dalio underscores the challenge of maintaining a balance. A substantial quantity of debt needs to be bought at a sufficiently high interest rate to avoid a crisis. Looking ahead over the next 5 to 10 years, Dalio suggests that continuing on the current trajectory could make this balancing act increasingly difficult. Addressing the evidence of a shortage of buyers for federal debt, Dalio observes that the amount of government debt being sold has recently collapsed. This is evident from the hiatus in issuing government debt, followed by a forthcoming surge in debt issuance. As the situation unfolds over the next year or two, it's anticipated that there will be a clear understanding of the supply-demand dynamics for government debt, with indications of a significant shortage in buyers. Dalio has elucidated that the government engages in selling its debt, a process that involves borrowing funds from the financial markets to cover various expenses, such as infrastructure projects or public programs. The mechanism employed by the government is the issuance of treasury securities, which are essentially promises to repay a specific amount of money with interest over a designated period. To delve further into this, consider the scenario where investors, ranging from individuals to large financial institutions and foreign governments, purchase these treasury securities. In doing so, they effectively lend money to the government and, in return, earn interest on their investment. This practice allows the government to raise capital to finance its operations without solely relying on taxation. However, the concern raised by Dalio revolves around the diminishing demand for U.S. debt instruments. If there's a decline in demand for these instruments, it implies that fewer individuals and investors are willing to lend money to the U.S. government. This, in turn, presents several challenges. Firstly, the government may be compelled to offer higher interest rates to attract lenders, as is customary when the demand for a product decreases. Secondly, if the trend of decreasing demand continues, it could become increasingly difficult for the government to raise the necessary funds. To illustrate, think of a situation where you need a loan, and fewer banks are willing to lend to you, creating financial challenges. Bringing it all together, as the federal government deficit grows significantly, there is a compulsion to issue more debt instruments. This is done to bridge the gap between the taxes collected and the annual spending requirements. To put it simply, if the demand for U.S. debt diminishes, it could lead to a scenario where the government faces challenges in securing funds, possibly requiring higher interest rates and encountering obstacles in meeting its financial needs. Upon delving deeper into Dalio's message, a significant concern emerges. He emphasizes the potential problems associated with the declining demand for these debt instruments. When fewer people are interested in these instruments, it leads to a crucial outcome: the interest rates on the securities go up. This is worrying because we already allocate a large amount of money to cover interest expenses. If these rates increase further, it poses a serious threat to our economic stability. Raising interest rates on government instruments doesn't just affect them alone. It has a ripple effect, influencing interest rates across the board. If the situation is taken to the extreme, it can slow down economic growth, possibly causing a recession. The delicate balance between a growing federal deficit, reduced demand for debt instruments, and the need to raise interest rates creates a fragile economic balance. It's essential to maintain this balance to avoid negative consequences for the broader economy. Looking at history helps us understand the gravity of the situation. In the past, when countries allowed their federal deficits to rise unchecked and the demand for debt instruments decreased, they had to raise interest rates. This has not only hampered economic growth, but in extreme cases led to recessions. Learning from history, we see that the equilibrium between these factors isn't just a theoretical concern. It has real-world implications. If we tread down a risky path and face economic challenges, the issues we encounter extend beyond simple financial troubles. Given the challenges that the US faces, particularly the financial struggles, there's a need for a plan to get out of this tough spot. The second problem the US often deals with is internal conflict. According to Dalio, when looking back in history, it's common to see financial difficulties and large wealth gaps leading to the rise of populism. Populists are individuals or leaders who are willing to win at any cost, not caring much about the rules. This can lead to extreme behavior in both political parties, as witnessed in incidents like January 6th. Dalio suggested the way the US political system works, especially during primaries and within political parties, tends to create this division. To avoid problems, according to Dalio, the US needs a positive outcome, and that's having a strong bipartisan middle ground. Extremes on either side, whether it's the far right or far left, won't be good for the US situation. Currently, Dalio notes that people are moving to different areas, not just because of taxes, but also because of differences in values. This separation is a concern, and in the next 2 years, according to Dalio, the big question is whether the US can maintain a strong bipartisan middle, or if there will be more fragmentation. Now, looking at the short-term debt cycle, which Dalio calls the 7-year cycle, the US is about halfway through it. According to him, interest rates are at a level where they might not go up much, but they won't likely go down either. This tight situation is going to impact the US economy, making it weaker going forward. It might not be a massive downturn, especially due to the household sector, but it will be a recession affecting balance sheets. Combining this financial issue with internal conflicts, Dalio suggests that it makes for a risky situation, and it's likely that things will get tougher in the US economy. However, alternative perspectives suggest that while concerns of a crisis persist, it might not reach the massive scale witnessed in 2008. In 2023, conditions unfolded more favorably than what the markets had anticipated. Economies remained robust and inflation declined faster than consensus expectations. This positive turn of events resulted in better-than-expected returns, especially for AI-related companies like the Magnificent Seven. These companies experienced attractive returns, while cash saw gains, bonds showed minimal returns, and commodities presented mixed outcomes. Examining the growth landscape, 2023 showcased relatively low unemployment alongside high wage inflation, contributing to favorable personal earnings. This resilience helped the economy endure tightening measures. Nevertheless, higher interest rates had a dampening effect on interest rate-sensitive sectors like real estate, venture capital, and private equity, leading to some debt bubbles quietly bursting. A detailed, bottom-up micro perspective of 2023 reveals that well-financed, new-era disruptor companies, particularly those in AI, outperformed old-era companies facing disruption. Earnings expectations for these companies surged, reflected in interest rate-adjusted PEs. Thanks to MP3 fiscal monetary policies, the private sector's balance sheets and cash holdings improved. Additionally, in managing 2023 inflation, there were better-than-expected adaptations to supply chain disruptions, along with government-created policies favoring onshoring and nationalism over globalization, contributing to low inflation in the goods-producing sectors due to productivity improvements. Despite these positive trends, challenges loom on the global stage, with the Russian invasion of Ukraine, the US engaged in a semiconductor chip war with China, and unrest in the Middle East sparking a new conflict. The entanglement of Iran with the US adds to the complexity, making the outlook for the year daunting. In essence, for the US, at least in economic terms, the year might prove challenging, a sentiment supported by Ray Dalio. The unfolding events will determine the actual impact on the US economy. By that, we've reached the end of today's video. If you enjoyed it, don't forget to hit the like button, subscribe to the channel for more updates, and don't forget to check out our video on the Florida housing sector. See you in the next video.